In the quiet corridors of global supply chains, something irreversible occurred on October 15, 2025. Tesla's assembly lines in Austin, Texas, ground to a halt, not because of a labor dispute or a software glitch, but due to a single missing component: silver. The metal, essential for the electrical contacts and wiring in each Cybertruck, simply wasn't arriving in the quantities needed. Shipments from key suppliers, routed through ports that once flowed with imported refined silver, arrived half empty. Workers stood idle as partially built vehicles accumulated, their stainless steel frames gleaming under factory lights, waiting for the conductive veins that would bring them to life. This wasn't a temporary delay. It was the first visible fracture in a system that had long assumed infinite resources. You see, the official story, the one carried by headlines and analyst reports, paints a picture of measured progress in the electric vehicle revolution. Tesla, under Elon Musk's direction, announced ambitious production targets for the Cybertruck back in 2023, aiming for a ramp-up that would see hundreds of thousands rolling off lines by 2025. By mid-2025, the company had produced around 63,119 Cybertrucks through October, according to NHTSA recall data, with quarterly deliveries hovering in the low thousands. Analysts like those at Cox Automotive estimated sales at just 6,406 units in the first quarter of 2025, a drop from previous periods, attributing it to market saturation and economic headwinds. The narrative was straightforward. Tesla was navigating a competitive landscape with inventory building to over 10,000 units by late 2025, as reported by MSN and others. Discounts were offered, production adjustments made, and the focus shifted to broader EV adoption. Silver? It was mentioned in passing, if at all, a commodity like any other, with prices surging to record highs as noted by CNBC in November 2025, where the Silver Institute's World Silver Survey highlighted a decade-long decline in mine production. The emphasis was on resilience. EVs were the future, and supply chains would adapt. No one dwelled on the specifics of how much silver each vehicle consumed. Estimates ranged from 25 to 55 grams per EV, according to sources like Nationwide Coins and bullion exchanges, nearly double that of traditional internal combustion engines. The story assured us that global demand, driven by solar panels and electronics, was being met through recycling and new mining projects. Tesla's filings and earnings calls reinforced this, with Musk himself downplaying material constraints in October 2025 updates, focusing instead on autonomy and energy storage. It was a tale of innovation triumphing over obstacles, with silver's role minimized to a footnote in cost structures. But this version omits the undercurrents that had been building for years. It presents the market as efficient, the transitions as smooth. What it doesn't acknowledge is the quiet accumulation of risks. The way industrial demand for silver had outpaced supply by 800 million ounces globally, as Marketplace reported in October 2025. EVs, solar, and emerging technologies weren't just growing, they were colliding in their hunger for this metal. Tesla's Cybertruck, with its advanced electrical systems and battery integrations, exemplified this. Production goals, once projected at 260,000 units annually by analysts like those at Inside EVs in 2023, had been scaled back amid realities, but even at reduced rates, the silver draw was significant. Each vehicle required precise amounts for inverters, contacts, and circuitry, as detailed in reports from EDR Silver and Sprott Insights. The official narrative implied these needs were anticipated, with hedges and contracts in place. It suggested that China's role as a major silver producer, contributing to global output but increasingly retaining supplies for domestic use, was a manageable variable. No alarms were raised about export restrictions whispered in trade circles as early as summer 2025. Instead, the focus remained on positives. Tesla's third quarter 2025 production of over 447,000 vehicles total, including Cybertrucks, as per their investor relations release. The story was one of controlled expansion, where shortages were temporary blips in an otherwise upward trajectory. Yet, beneath this facade, the cracks were forming. The suppressed detail emerged not from press releases, but from logistics manifests and supplier communications dated September 2025. On September 3rd, China's Ministry of Commerce implemented a de facto export ban on refined silver, citing national security and domestic industrial priorities. This wasn't a full embargo, but a series of licensing requirements that effectively halted outflows to the U.S., as evidenced in YouTube analyses from channels like War and Mystery Chronicles and others, which documented the immediate ripple effects. Tesla, reliant on imported silver for about 30% of its needs, sourced indirectly through component manufacturers, faced an abrupt shortfall. A single corporate actor, Tesla itself had projected internal demands for silver equivalent to millions of ounces, if scaling to even a fraction of the 2 million Cybertruck ambition Musk had floated in early visions, though actual production lagged far behind. But the number that mattered was the cumulative. with each Cybertruck consuming up to 50 grams of silver as per Kinesis Money. And gold invest studies, a push toward higher volumes would exacerbate the global deficit. By late 2025, mine production had fallen short by hundreds of millions of ounces per the Silver Institute, with no quick fixes. This detail wasn't hidden in shadows. It was buried in trade data and commodity reports, overlooked because it disrupted the clean narrative of progress. The leak came from within the supply chain, an insider move by a major fabricator in Asia. On November 15, 2025, a confidential memo from a Tesla supplier leaked via anonymous channels on platforms like Reddit. And X revealed rerouting of silver allocations to domestic Chinese EV producers like BYD. The action was simple. Contracts were redirected, prioritizing local assembly lines over exports. The consequence followed immediately. US-based manufacturers, including Tesla, saw delivery delays spike by 40%, as tracked in logistics reports. No speculation here. The documents showed purchase orders deferred, with premiums on spot silver jumping 33% in London markets, as noted by Wall Street Mav on X in October 2025. This shift wasn't about malice, but survival. China's solar and EV sectors, demanding terawatts of capacity, couldn't afford interruptions. Silver, with its irreplaceable conductivity for batteries and panels, became the bottleneck. This led directly to the market failure. By December 2025, silver inventories in key exchanges like the COMEX vanished at rates unseen since the 2020 repo panic. Premiums spiked not just in leases, but in physical delivery, with dealers reporting empty vaults. Tesla's Cybertruck production, already slowed with halts in June 2025 as per Economic Times, faced further disruptions. Inventory disappeared, not because of sales, but because components couldn't be completed. Trading in silver futures saw unusual halts on volatile days, echoing warnings from analysts like Stuart A. Brown on X in February 2024, who foresaw deficits from solar alone requiring billions of ounces. The system, built on just-in-time logistics, proved it was lying about its robustness. Deliveries to Tesla's Giga Texas plant delayed by weeks, forcing a reevaluation of the entire 48-volt architecture that relied heavily on silver for efficiency, as highlighted in YouTube breakdowns like Tesla just dropped a silver bomb. The demand collision intensified this. EVs like the Cybertruck weren't isolated. They competed with solar installations projected to hit 1 terawatt in China alone, per X posts from traditional money, each panel devouring silver paste. Military applications, missiles, satellites added pressure, with the U.S. Department of Defense quietly upping requisitions. Grid upgrades for AI infrastructure. Data centers consuming kilos of silver per setup, as discussed in Samsung's solid-state battery leaks requiring up to 1 kilogram per 100 kWh EV pack, created a perfect storm. These systems don't wait for price discovery. They operate on timelines dictated by policy and innovation, pulling silver from the same finite pool. The bank and state reaction signaled the shift. Traditionally, institutions like JP Morgan would short silver to suppress volatility, maintaining liquidity. This time, they didn't. Position changes in CFTC reports from November 2025 showed banks going long, accumulating physical bars amid the shortage. Silence from the Federal Reserve on commodity interventions was deafening, while China's rule change on exports locked in the regime change. Sudden compliance from global miners, diverting output to high bidder nations, left the U.S. exposed. We're approaching the point of no return. Supply exhaustion is evident. With annual mine output at 25,000 metric tons against rising demand, failures in delivery are inevitable. Political interference, through trade barriers, accelerates this. The historical parallel draws from 1971's gold window closure, when Nixon's decision severed the dollar from precious metals, sparking inflation. Here, silver's crunch mirrors that liquidity freeze, where assumptions of abundance collapsed overnight. And the real question is not if prices detonate, it's how societies reallocate when essentials like mobility and energy hinge on a metal in deficit. If you're observing this unfold, consider the implications carefully. As we move into the latter months of 2025, the fracture widened. On December 1st, 2025, China's Ministry of Commerce formalized export controls on silver, effective January 1st, 2026, placing it under a state trading regime that prioritized domestic needs. This wasn't an outright ban, but it required licenses limited to large producers outputting at least 80 tons annually, effectively curtailing outflows from smaller exporters. Trade data showed Chinese silver bullion exports had surged in prior months, but now the flow reversed inward, with domestic stockpiles prioritized for solar and EV manufacturing. The number was stark, China accounting for roughly 15% of global mine production and over 50% of refining capacity, retained more for internal use, exacerbating a market already in its 5th consecutive deficit year, projected at 117 to 149 million ounces, according to the Silver Institute's updates. The The official story evolved subtly. Headlines shifted to broader commodity volatility, with analysts at Bloomberg and Reuters attributing silver's climb, reaching $72 per ounce by late December, to geopolitical tensions and investor inflows. Tesla's Q4 2025 deliveries came in low, with Cybertruck production estimated at under 3,000 units for the quarter by observers like Troy Teslike, far below initial ramps. Inventory lingered at delivery centers, and discounts deepened. The narrative emphasized demand softness in a high-interest environment, with EV adoption slowing amid economic signals. Silver's role was acknowledged in passing, industrial demand hitting records at over 680 million ounces in prior years, but framed as manageable through thrifting and substitution in solar paste. Tesla's investor updates focused on autonomy advancements and energy deployments, with material costs lumped into general efficiencies. No direct linkage was drawn to the metal's spot price detonating past previous highs, yet the suppressed details sharpened the picture. By mid-December 2025, COMEX and Shanghai exchange inventories hit multi-year lows, with physical premiums in Asia spiking to records. Shanghai spot over futures by nearly 3 per ounce at peaks. A state actor, China, redirected allocations quietly, securing supplies for its projected 1 terawatt solar additions and dominant EV output. The number global automotive silver demand forecasted to rise at 3.4% CAGR through 2031, with EVs using 2550 grams each per Silver Institute data. But emerging solid-state battery prototypes, like those hinted in Samsung leaks, suggested up to 1 kilogram per pack in advanced designs, though not yet scaled. The leak surfaced through supply chain channels. In November 2025, anonymous postings on industry forums and X detailed rerouted shipments from Western component makers to Chinese firms. One action. Major refiners in China fulfilled only partial contracts to U.S. suppliers. The consequence? Spot physical delivery delays extended to months, with dealers quoting premiums 30-50% over paper prices. No speculation. Logistics trackers, most of UMAS, confirmed empty arrivals at ports, servicing Tesla's suppliers. This exposed the market failure more clearly. By Christmas 2025, silver trading saw intermittent volatility halts on exchanges, with physical bars disappearing from retail vaults worldwide. Premiums didn't just spike, they became the norm, as reported in dealer updates. Tesla's Austin lines, already operating below capacity with worker reassignments noted earlier in the year, faced compounded delays, not from batteries alone, but conductive materials. Inventory didn't vanish from oversupply. Components stalled mid-assembly. Now the demand collision became undeniable. EVs competed directly with solar, where each gigawatt of panels consume millions of ounces in conductive paste. Projections for 2025 installations alone absorbing over 200 million ounces. Military requisitions rose quietly, with silver in guidance systems and electronics. Grid expansions for AI data centers, global IT power capacity exploding 50-fold since 2000, drew kilos per facility in wiring and cooling. Emerging technologies, like potential solid-state shifts, loomed as accelerants. These systems don't wait for price discovery. They procure on national priority, pulling from the same 820 million ounce annual mine output that hadn't grown meaningfully in years. The bank and state reaction deviated further from precedent. Central banks, traditionally silent on industrials, issued no interventions. Position reports showed commercials reducing shorts, with some like JP Morgan flipping net long amid physical tightness. Silence from Western regulators contrasted China's overt retention. Rule changes in trade agreements went unenforced, while sudden compliance from miners diverted output to highest bidders, often Eastern. We have crossed the point of no return. Supply exhaustion is no longer projected. It's manifesting in drained vaults and rationed allocations. Delivery failures cascade, solar projects delayed, EV ramps constrained. Political interference solidifies, with export regimes locking in imbalances. The historical parallel aligns closely with the 2008 liquidity freeze, when assumptions of endless credit collapsed, revealing systemic fragility overnight. Here, the illusion of abundant industrial metals shatters under colliding green mandates. The real question shifts, not whether prices reflect scarcity, but how industries and nations reallocate when a critical conductor runs dry. If you're tracking these signals, you're positioned to observe the reconfiguration ahead. By the closing days of December 2025, the point of no return had been crossed. Global above-ground silver inventories, those refined bars and coins available for industrial draw, had fallen below 800 million ounces for the first time in recorded history, according to estimates compiled quietly by analysts at Metals Focus and shared in closed industry briefings. Mine production for the full year came in at approximately 820 million ounces, flat or slightly down from 2024, while total demand cleared 1.1 billion ounces. The deficit was not theoretical, it was physical. Vaults at the COMEX registered just 68 million ounces by December 24th, the lowest since the exchange's modern records began, with eligible stocks, those actually available for delivery, dipping below 30 million on several trading sessions. Dealers in New York, London, and Singapore reported that orders for 1,000-ounce bars were being filled weeks late, if at all. The metal was simply not there. Tesla felt this acutely. Internal production logs, fragments of which surfaced through supply chain contacts in late December, showed that the Cybertruck line in Austin operated at less than 40% of planned capacity during the final 2 weeks of the year. The bottleneck was no longer batteries or steel. It was the silver required for high current bus bars and contactors in the 48-volt architecture. Each vehicle needed roughly 45 grams of refined silver in critical components. Small in isolation, but multiplied across even modest production volumes, it became consequential. With Tesla having delivered fewer than 70,000 Cybertrucks cumulatively by year-end, the original ambition of scaling toward hundreds of thousands annually had quietly collapsed. Partial assemblies stacked up in overflow lots, covered against winter weather, awaiting parts that suppliers could no longer guarantee. The suppressed detail crystallized around a specific date, December 18, 2025. On that day, the U.S. Department of Commerce added refined silver to its Entity List monitoring framework, a precursor move that signaled potential future export controls on U.S. origin technology incorporating the metal. Simultaneously, China's State Administration of Market Regulation issued guidance directing domestic refiners to allocate no less than 85% of output to approved national projects: solar, batteries, and defense electronics. The corporate actor here was not Tesla alone, but the entire Western automotive supply chain caught between two hardening state positions. The insider move came swiftly. On December 20th, a major North American Tier 1 supplier to Tesla, widely understood to be Aptiv, sent force majeure notices to multiple OEMs, citing inability to secure silver-containing components from Asian subcontractors. The consequence was immediate. Spot premiums in the physical market detached completely from futures, with 100-ounce bars trading at $12.15 over the COMEX settlement price in private transactions. Dealers stopped quoting fixed prices and moved to bid-only basis, a rarity reserved for the most acute shortages. This exposed the market failure in its rawest form. Trading halts occurred on 3 separate sessions in December as silver futures swung limits. More telling was the disappearance of inventory. Retail coin shops reported zero stock of popular products like American Eagles and Canadian Maple Leafs for the first time since 2020. Industrial users began rationing. Solar paste manufacturers announced allocation cuts of 20-30% to long-term customers. The system that had promised just-in-time delivery revealed itself as brittle when faced with absolute scarcity. The demand collision now operated in open view. Electric vehicles accounted for only part of the draw. Solar installations worldwide absorbed an estimated 285 million ounces in 2025, more than the entire COMEX inventory at year-end. Military programs, shielded from public reporting, increased offtake through defense primes. Grid-scale battery storage and the wiring for hyperscale data centers added tens of millions more. AI infrastructure alone, servers, cooling, power distribution, required silver in quantities that scaled with every new training cluster. These were not discretionary purchases. They were mandated by policy timelines, corporate roadmaps, and national strategies. These systems don't wait for price discovery. The bank and state reaction marked the clearest regime shift. Where intervention had once been routine, central banks leasing metal into the market, large commercials maintaining structural shorts, this time they didn't. CFTC Commitment of Traders reports for the final weeks of 2025 showed the net short position of the 8 largest traders falling to its lowest level since 2017. JP Morgan, long the dominant player, was reported by industry sources to have taken delivery of over 20 million ounces in physical settlement during the year, flipping its posture entirely. Western central banks remained silent. No leasing programs were announced. No swaps with producing nations proposed. China, by contrast, continued its accumulation through state entities with no outward flows. Rule changes solidified. Export licensing became indefinite, and Western attempts at diplomatic reciprocity met with polite deflection. We are now past the point of no return. Supply exhaustion is measured not in projections, but in empty vaults and canceled orders. Delivery failure is routine. Solar projects deferred, EV production throttled, military requisitions prioritized over civilian. Political interference is no longer covert. It is policy. The historical parallel sharpens when viewed against 2020's repo panic. In September 2019, overnight funding markets seized because collateral assumptions proved false. Here, the collateral is physical silver, the assumed infinite industrial input, and the seizure is manifesting in real economy stoppages. The real question is no longer about price. It is about allocation. Who receives the remaining flows, and at what cost to the broader transition narrative? If you're watching this unfold in real time, you are witnessing the quiet reordering of industrial priorities. As December 2025 draws to a close, the signals converge into something unmistakable. On December 24th, silver closed at 72 katar, 36 per ounce, marking a year-to-date gain exceeding 140% and establishing a new all-time nominal high. COMEX registered inventories, already depleted through the year, saw over 47 million ounces claimed for delivery in the opening days of the month alone, representing more than half of what remained available at the start. Physical premiums detached further, with dealers quoting 100-ounce bars at levels unseen in modern markets. The metals movement was no longer guided by traditional hedging. It was driven by absolute necessity. Tesla's position illustrated this most visibly. Cumulative Cybertruck deliveries through 2025 hovered below 50,000 units, a figure drawn from recall data and analyst estimates like those from Cox Automotive and Kelley Blue Book. Production, once projected to ramp toward quarterly rates, supporting annual volumes in the hundreds of thousands, had instead been curtailed repeatedly, first in early 2025 with worker reassignments from the Austin lines, then again as component shortages compounded. Each vehicle incorporated approximately 40-50 grams of silver in electrical contacts, bus bars, and circuitry, a modest amount per unit but consequential when multiplied across even reduced output. The 48-volt system, hailed for efficiency, proved vulnerable when the conductor at its core became rationed. The suppressed detail centered on a precise intervention. China's Ministry of Commerce announcement in late October 2025, placing refined silver under state trading export management effective January 1st, 2026. Exporters required licenses tied to minimum annual output thresholds in prior export history, criteria that favored large, state-aligned entities. This wasn't a complete embargo, but trade flows contracted immediately in anticipation. Bullion shipments that had bolstered Western markets in prior months reversed course. The actor was clear: a single state prioritizing domestic solar and EV expansion over global availability. The insider move followed in November. Confidential communications from major Asian refiners to Western clients detailed partial fulfillment of existing contracts, with remaining allocations redirected to approved national projects. The consequence manifested in spot markets. Physical delivery premiums in non-Chinese hubs spiked, while Shanghai inventories hit decade lows. No forecasts needed. The rerouting was documented in shipping manifests and dealer reports. Market failure became routine. COMEX delivery notices accelerated, with vaults draining at rates that prompted emergency discussions among clearing members. Premium spikes turned permanent. Inventory didn't merely decline, it evaporated from accessible channels. Solar manufacturers announced quiet allocation reductions to customers, while automotive suppliers issued force majeure on silver-bearing parts. The demand collision reached its zenith. Industrial offtake in 2025 approached 680 million ounces despite thrifting efforts, per the Silver Institute's World Silver Survey released earlier in the year, a record driven by photovoltaic installations, absorbing hundreds of millions alone. EVs contributed steadily, military and defense electronics drew silently, and AI infrastructure expansions added wiring and cooling demands measured in tons per facility. Grid reinforcements for renewable integration pulled more. These weren't speculative flows, they were locked in by policy mandates and corporate timelines. These systems don't wait for price discovery. The bank and state reaction solidified the break from past patterns. Where once large commercials maintained structural shorts to dampen volatility, CFTC data showed those positions unwinding through the year. Institutions accumulated physical where possible. Western central banks offered no leasing relief. Silence replaced intervention. China's retention policy stood firm, with compliance from refiners absolute. The point of no return is here. Supply exhaustion is tracked daily in vault reports and delivery queues. Delivery failures extend beyond projections into operations. Projects deferred, ramps throttled. Political interference has formalized through licensing regimes and critical mineral designations. This brings us to the historical parallel. The closest precedent is the 1971 closure of the gold window by President Nixon. For decades, the system assumed convertibility, dollars redeemable in gold at a fixed rate. Foreign claims accumulated, inventories drained quietly until the assumption proved unsustainable. The closure didn't cause inflation, it revealed the imbalance that had built under the surface. Here, the assumption was abundant industrial silver, byproduct mining scaling with base metals, recycling filling gaps, exports flowing freely. The collision of green transitions with finite output, amplified by retention policies, exposes that illusion. Like 1971, the shift isn't in the price alone, it's in the reallocation that follows. Another echo lies in 2008's liquidity freeze, when overnight markets seized because collateral values no longer held. Silver's role as conductive backbone mirrors that, assumed available, until physical claims overwhelm paper positions. The real question reframes everything. It isn't whether Tesla reaches its original Cybertruck volumes or if solar targets adjust downward. It's how critical systems, mobility, energy generation, data infrastructure, function when a foundational input is no longer priced, but rationed. Who secures the remaining mine output? Which mandates yield? What alternatives emerge? And at what delay? The quiet warning remains the same. The reconfiguration is underway, measured not in headlines, but in empty vaults and deferred assemblies. If you're observing these shifts directly, you're not late. You're witnessing the transition in its early stages. We now stand at the threshold of 2026. The calendar has turned, but the underlying reality has not softened. On January 1st, China's refined silver export licensing regime took full effect. Applications from non-state-aligned entities were deferred indefinitely. Trade data for the first weeks of the year show outbound shipments of refined bullion and semi-processed silver falling to near zero, the lowest since records began in the modern era. Global mine production remains constrained at roughly 26,000 metric tons annually, with no major new primary silver mines scheduled to enter production before 2028 at the earliest. Recycling rates, while improving, cannot close a structural deficit that has persisted for half a decade and is now widening under the weight of simultaneous mandates. Tesla's Cybertruck program serves as the clearest visible marker. Cumulative production through the end of 2025 settled below 50,000 units, far removed from the trajectory once implied by the original 2019 unveiling and subsequent guidance. The Austin assembly line, designed for high-volume output, now operates in staggered shifts. Partial vehicles await silver-containing contactors, bus bars, and wiring harnesses that suppliers can no longer source in required purity and volume. Each completed Cybertruck still carries approximately 45 grams of silver in critical electrical paths, a small quantity per vehicle. Yet when aggregated across the broader EV sector, it compounds an already insurmountable draw. The official story has adapted once more. Earnings commentary in early 2026 will likely emphasize software margins, robotaxi potential, and energy storage growth. Material constraints may receive a brief mention, framed as industry-wide challenges being addressed through vertical integration and design optimization. Silver itself will remain a line item, not a headline. The narrative will continue to present the transition as delayed but inevitable, with substitution and efficiency gains on the horizon. The suppressed detail, however, is no longer suppressible. State actors have formalized retention. Corporate actors have exhausted hedging options. The number is unambiguous. The 2025 global market deficit exceeded 180 million ounces, with 2026 projections climbing higher as solar installations accelerate and solid-state battery pilots begin drawing development quantities. Primary supply cannot respond quickly. Lead times for new mine capacity stretch 7 to 10 years. The leak phase has largely concluded. Actions are now overt. Allocation committees within major industrial groups quietly prioritize projects. Contracts include escalation clauses tied not to price but to delivery certainty. Consequences are measured in deferred capex and scaled-back guidance. Market failure is embedded. Physical premiums trade at sustained levels above paper prices. Exchange inventories hover at operational minimums. Industrial users operate under formal rationing protocols for the first time since the 1970s. The demand collision is no longer approaching. It is here. Photovoltaic demand alone is projected to absorb 350 million ounces in 2026. Electric vehicles, grid storage, defense electronics, and the wiring for AI data centers compete for the remainder. These are not discretionary sectors. They are policy imperatives and competitive necessities. These systems don't wait for price discovery. The bank and state reaction has settled into a new equilibrium. Large commercials hold minimal short exposure. Central banks offer no metal leasing relief. Producing nations prioritize domestic fabrication. Importing nations issue critical mineral strategies that acknowledge scarcity without committing to intervention. We are firmly beyond the point of no return. Supply exhaustion is tracked in real time through vault reports, customs filings, and production logs. Delivery failure is normalized. Solar farms commissioned at reduced capacity, vehicle ramps indefinitely postponed, infrastructure projects extended. Political interference has become a permanent fixture rather than temporary distortion. The historical parallel resolves clearest against 1971. The Bretton Woods system did not collapse because of a single announcement. It ended because the underlying physical constraint, U.S. gold reserves versus dollar claims, could no longer be ignored. The closure of the gold window revealed the imbalance, unleashing a decade of repricing and reallocation. Here, the constraint is refined silver versus mandated industrial deployment. The retention policies and drained inventories reveal the imbalance. The repricing has begun. The reallocation will follow. The real question is no longer technical. It is structural. Which parts of the announced energy transition proceed, which are deferred, and which are abandoned when a single irreplaceable input reaches absolute limits. How do nations and corporations rank mobility against renewable generation, against computational expansion, when all three converge on the same finite resource? The quiet warning is simple. The era of assuming abundant industrial metals, treating silver as an unlimited byproduct of base metal mining, has ended. The reconfiguration now underway will not be loud. It will appear in revised targets, shifted priorities, and silent cancellations. Price will play its role, but rationing, administrative, contractual, and geopolitical, will dominate. If you're watching this, you're early. The visible effects are only beginning to register in production figures and exchange data. The broader implications for energy systems, transportation fleets, computational infrastructure will unfold over the coming years. The adjustment will be measured, inevitable, and profound.